20th. Let me see if the mic's good. Okay, it's good. And it's a historic day, not because it's 420, but because the oil market went negative today. So it went all the way down to negative $40. What that means is that if you basically can hold oil, if you can store it somewhere, you'd be getting paid $40, right? Someone wants to give you a barrel of oil and give you $40 along with that as a gift. That's what that means, okay? It's negative prices. Getting paid to own something, okay? So obviously the issue behind that is because of storage. There's not enough storage out there, and people are struggling to keep all this excess oil coming in. And of course, production can't be turned off because of political reasons, etc. You can't just send all these people home, shut down operation. A lot of dictatorships like Saudi Arabia would probably have revolts, and they're a huge oil producing nation, as well as Russia. I mean, that's going to be tough, right? You want to keep everybody on the payroll. So that's not the only reason. Of course, you have all kinds of pipelines and everything. So and there's more coming. So we saw negative. It's in the futures prices, basically in the May futures are turning negative. Further out, they're positive, but those might go negative as well at some point if this continues. There might be way too much oil coming in, so that's interesting. Now that's creating some side effects. Of course, that affects the entire economy, the industry, everything. But it's not a good sign because that means there's not a lot of production that's going on of goods and and services, and people are also not driving around, so services are not being used. So it doesn't spell good for the stock market. So I think this might be the reason why the stock market now rolls over, and at least we retest the lows. So this bull trap that I've been calling it for the past month or something, past few weeks, might be coming to an end here. So we might see some lower prices in equities coming in, because this is some pretty raw data. You can't fake this stuff, right? Now, other things that's going on is I want to talk about necessarily here is the not junior, but gold miners and etc. and what's going on with the mechanics there, and what I speculate is going to happen with the gold miners and the prices of the metal here. So first, before I get into that discussion though, let's go into the account so I can show you where I'm sitting at. I just happen to be sitting at 70,477. I was down a little bit today. Was up almost at 71,800, somewhere 900, somewhere like that, almost 72. These are my options. I've sold some calls against my positions to collect some revenue here, and as you can see, some of them are paying off, and some of them are not. The call that I bought for Apple is going down. Apple is going down itself. I have 80 shares, as well as the Apple call. So bought, not sold. And the rest of my account has also been going down, except a few things, namely mining stocks. So that would be Wheaton Precious Metals, SIL, which is an ETF of the silver mining stocks, and as well as uranium, energy fuels to be exact. Chemicals been staying pretty steady. Everything else is down. As you can see if you're interested in the positions that I hold, you can read the symbol here and the number of shares I have, and you can extrapolate the rest of the data. Now I've turned 0.5% bearish already. Hopefully tomorrow is another bull day, and then I can go even more bearish. But I don't know. I'm not really betting on that. So I think I might be buying more SDAO here. So this is a leveraged ETF. You don't want to hold these for a long time. They're very dangerous. In fact, I have a video that's about leveraged ETFs to stay away from them unless you understand how the mechanics work and what the risks are. So here we go. 10 shares of SDAO, up $16 today. So offsetting the downward movement in the account by a tiny bit. And then I actually bought OIL, which is an ETF that is somewhat tied to the price of oil. Not really. I mean, it is, but let's take a look at it. We can read the description together. As you can see, it's been a major bear market here. So in the past 5 years, it's gone from plus 53 to negative 62. So I mean, that's quite a bit. It's down like, I don't know, 80%, something like that. So here is the description on all that tracks the index of front month WTI crude oil futures contracts. Now, as we know, they went negative, so it doesn't really track them that accurately. It's a composite of features, and this ETF is not designed to go below zero, but if this is as low as it's going to go, which it may not, I choose to buy it here. So I bought at somewhere around this price down here at the bottom, and it might go lower. I'm not sure exactly how the mechanics are going to play out, because this is such an unprecedented time in history. Oil price has never gone negative, and now it's negative $40. Okay, I mean, I don't know exactly what it is right now at this very moment, but it reached as far as negative 40, I believe. It is sitting at 0.1, so 10 cents per barrel right now. So I'm buying this not because I think it's going to go up in the near term, but the long term, in a few years, this is going to be if I manage to hold the fund, this is going to be a very profitable position. But I don't know if I'll be able to manage. I'll probably sell out at some point, some silly time, because I don't usually trade the oil market. And although I think I know what's going on, I might be at a huge disadvantage here. Okay, so I want to go short a little bit. First time I'm now 0.5% bearish on my accounts. I've been bullish ever since the drop started here, and I've lost a lot of money because I was bullish too early. But nevertheless, I've managed to recapture some of this bull trap rally, and now if it's rolling over, my account margin is quite a bit lower. So as you can see here, I'm sitting at below 21% margin, which is great, all things considering. And I'm not super bearish because, as you may know here, there's no end to what the Federal Reserve and the central banks around the world will do in order to keep the prices of markets elevated. So whatever crash we might get, it'll probably be temporary and last no longer than a month or something, and then it'll probably level off. We may see low prices for a long time, for many years, but I know that there'll be plenty of money printed in order to buy up some of these troubled assets, which is almost every asset out there nowadays. Okay, now that that's happening, let's talk about the junior. I'm sorry, I keep saying junior, but we got to talk about the gold miners. So here's what I've been thinking, right? So I've had a lot of time to think, and many people have had a lot of time to think. And what I'm thinking is this. A lot of the gold miners, let's just talk gold miners for right now, and silver, and other commodity producers, but let's just stick to these. What they do is they'll pre-sell their production into the futures market. Okay? So what they'll do is this. If they plan on producing, let's say, 1 million ounces, they might go out and pre-sell most of that on the future, saying like, hey, look, at the end of the summer, I will sell you 1 million ounces of gold. Okay? So basically what they're doing is they're selling a call option against their position, right? Which is non-existent yet. But they know they're going to mine 1 million ounces, so they want to sell it at a good price. So they'll pre-sell. Okay, that's normal, all right? But what happens now if they don't have, right, the gold, and the price of gold exceeds the strike price? Okay, so let's walk through it with the stock. What happens, right? Let's say I sell a call of Apple, 100 shares at 300, right? And Apple goes to 300, and my call is exercised. I have to sell 100 shares of Apple, yeah, at $300. Well, same thing happens with them. The future price is just options, basically. So what will happen is they'll have to sell 1 million ounces of gold at whatever price it is which is, I don't know, whatever the price they've locked in, maybe $1,600, $1,700 gold. But what happens if gold is above that price, and they're actually forced to sell? The call option doesn't expire, worthless, right? Well, where are they going to get these million ounces of gold if production is shut? So if they're not actually mining, where are they going to get it? So now they're on the hook, right? They may have to settle the contract with cash. So now you have all these gold miners that are actually hugely in debt. They have to borrow the money in order to pay off the contracts because they don't have the gold. So I believe what's going to happen is you're going to have a really up and down market, right? People that smelt this ahead of time, that will manage to close out their contracts early. They probably have already done it, right? But those who don't and are counting on production picking up later in the year, maybe they've sold a long-term contract. Well, they might be screwed, okay? These companies might be going under. They might be going bankruptcy. So, let's say half of the miners are not going to do that. Half of them will. And half of them, and maybe a good portion of them will do half of their production like that, right? What ends up happening is a no-go, right? There's going to be half the companies are going down, half of them going up. And there's going to be no action in the gold stocks, despite gold hitting all-time highs, right? So if gold decides to go to $2,000 or $3,000 or whatever, most of these, or a large portion of these companies, are not going to be able to participate in the upside of the price of the metal that they're mining. So I see danger. Now, what am I going to do about it? Am I going to sell all my mining stocks? I have a lot. No, I'm not going to sell. I'm going to trust the judgment of a lot of these managers. But many of them, I fear that they're going to go because of this dynamic. And I don't know how many of them realize this. Obviously, they're the professionals and they realize it, but maybe their judgment about when the economy is going to get restarted, when they're going to get labor, and when they're going to be able to start mining again, maybe they've misjudged that factor. And that's a risk there that's not easily dismissible. So instead of selling gold miners, I'm thinking of actually buying gold ETF, right? So in case the price goes way up, I even if I don't participate in the upside of the miners because there isn't any, at least I'll be able to participate in the upside of gold. But there is another scenario, right? Gold goes down. Then what? Okay, then what are we going to do? These mining companies are actually going to hang in there because the call option are going to expire. But the mining complex isn't going to make any money, and their future doesn't look very promising either. Probably not going to make any money in the future as well because of the low prices. So now everything goes to crap, right? So it's a very difficult decision, but I felt that I want to share this with you or whoever's watching because if you're considering, profiting off of the price movement of gold, okay, through the junior mine, or through the, I keep saying junior, through the gold miners, or juniors as well, then you may want to reconsider a different method. Maybe a call option on a gold ETF, okay? Or if you're savvy enough to trade the futures, and you can do that. But I think there's danger ahead, and these oil prices, even though it's going to cost them no energy, just labor to mine, the gold miners, for them to mine their product, their commodity, they can't do it. Everybody's on lockdown. No one's working. So now what? All right. Make another video on Thursday, probably. Peace out.